Hi there. If you're selling a UK property, paying your CGT online in 2026 is now a strict HMRC requirement. In this video, I'll walk you through every step so you avoid penalties instantly.
Hello there. So, you're planning on selling a valuable asset in the UK, perhaps a property, in 2026. Well, you need to know about a rule that catches thousands of people out. Once you sell, you could have just 60 days to report it and pay the tax. Miss that deadline, even by a single day, and you're looking at automatic penalties. It's a costly mistake for sure, but getting it right is actually pretty simple once you know the steps. And today, we're going to walk you through the whole process. Now, this guide comes straight from the expert tax advisors at My Tax Accountant, so you know you're in good hands. Let's get started.
Right, let's start with the most critical number of all, 60. 60. If you're selling a residential property in the UK, I want you to burn this number into your brain. You have exactly 60 days from the day the sale completes to get your report into HMRC and pay any tax you owe. It's a really strict, non-negotiable deadline. You know, a lot of people get caught out by this because they remember the old days when you could just sort it all out on your annual tax return. Well, those days are well and truly over.
So what's the big deal if you miss that 60-day window? Well, these days, the HMRC system is all automated. There's no one to call for a bit of leeway, there's no grace period. You're hit with an instant late filing penalty. And if you delay further, daily penalties start to kick in. Worse still, interest on the tax you owe starts racking up from day one. It's an expensive and honestly a completely avoidable mess to get into.
Okay, so to make sure that doesn't happen to you, here's what we're going to cover. First, we'll look at what we're calling the 60-day CGT trap. Then, we'll get into the nitty-gritty of paying for a property sale step by step. After that, we'll talk about other things like shares and art, and you'll want to stick around for our special alerts for crypto investors and business owners. Finally, we'll wrap everything up with a simple CGT action plan.
Right, first section. Before we jump into the how-to, we need to get our heads around the fundamentals. You know, understanding what capital gains tax actually is and why the rules have gotten so tough is really the key to making sure you stay on the right side of things. So what is capital gains tax? Let's keep it simple. It's just a tax on the profits, or what HMRC calls the gain, that you make when you sell or dispose of a valuable asset. So imagine a freelancer in London bought a little buy-to-let flat 10 years ago. If she sells it now for a lot more than she paid, that profit is her capital gain. That's the bit the taxman is interested in. And it's not just about selling, and this is important. Even gifting an asset to say your children can trigger a CGT bill. Now, how much do you actually pay? Well, for the 2025 to 2026 tax year, things have been simplified a bit. As you can see, it doesn't matter what you're selling, a house, shares, whatever, the rate you pay depends on your income. Think of your income for the year as filling up a bucket. If your gain fits inside your basic rate tax band, you'll pay 18%. But if that gain spills over into the higher rate band, you'll pay 24% on that bit. The key thing to remember is this: your total income for the year has a direct impact on your final tax bill.
And here is the real game changer. This number is why so many more people are getting dragged into the capital gains tax net. It's your annual tax-free allowance. You know, just a few years back, this was over £12,000. For the 2025-26 tax year, it's been slashed to just £3,000. What that means is that even pretty small profits you might make are now potentially taxable, and crucially, they have to be reported.
So who needs to have that 60-day property deadline circled in red on their calendar? Well, it's a longer list than you might think. Obviously, it's for individuals selling a second home or a rental property, but it also applies to trustees, people representing an estate, business partners, and this is a big one, joint owners. If you own a property with your partner or a friend, you both have to report your own share of the gain separately.
All right, let's get to the main event, the practical, step-by-step guide for when you sell a UK residential property. We're going to walk through HMRC's dedicated online system, which is called the CGT on UK Property Service. It can feel a bit daunting, but honestly, once you see the path, it's perfectly manageable.
It really just boils down to 4 main stages. First, create the right account. Second, get all your paperwork together. Third, you fill in and send off the return. And fourth, you pay the tax. Simple. Let's look at each one.
Okay, step 1, and listen up because this is probably the #1 mistake people make. You have to create a specific CGT on UK property account. Yes, you use your government gateway login, and this is so important, it is a totally separate thing from your normal self-assessment account. Just because you can log in to do your yearly tax return doesn't mean you're ready. You have to physically go and sign up for this special property service.
Step 2 is all about preparation. Before you even think about logging in, get your ducks in a row. You're going to need all this stuff right in front of you. The property details, the exact date you bought it, and of course, all the key figures. What you paid, what you sold it for, and a list of your costs. Things like estate agent fees and solicitor's bills. Trust me, spending an hour on this now will save you a world of pain later. Now, you'll really want to hear this part. Step 3 is submitting the return, and it's all about the deadline. That 60-day clock, it starts ticking from the date of completion. That's the day the money and keys actually change hands. It does not start when you exchange contracts, which can sometimes be weeks or months earlier. So many people get this wrong. Once you've got all your numbers from step 2, it's just a case of logging in and filling out the online form. And that brings us to the final step, paying up. Now here's my pro tip, and it is absolutely vital. After you submit your return, HMRC gives you a special 14-digit payment reference number. It will start with a letter X. You must use this exact reference. If you accidentally use your normal tax reference number, your payment will basically vanish into an HMRC black hole. They won't be able to match it to your bill, and you'll start getting penalty notices even though you've already paid. So always use the X number.
So that's property sorted. But what about everything else? What if you've sold some shares, or maybe a piece of art, or a commercial property? Well, for these things, the rules are totally different. You don't use the 60-day service. Instead, HMRC has another optional service called the Real-Time CGT service.
This table really shows the difference quite clearly. The 60-day service on the left is mandatory if you have tax to pay on a property sale. But the real-time service on the right is optional. It's basically a way to report and pay early if you want to, instead of waiting for your self-assessment. The deadlines are much, much more relaxed. But here's the key difference. Your accountant can use the property service on your behalf, but the real-time service? Nope, that one you have to use yourself.
Let's just walk through that timeline to make it super clear. So, the tax year starts on April 6th. Let's say you sell some shares in the summer. You can report that gain straight away if you like. The absolute latest you can report it using this real-time service is the 31st of December after the tax year has finished. The deadline to actually pay the tax is still the usual 31st of January. So as you can see, you've got a lot more breathing room. Okay, I need you to stay with me for this next bit, because it's a heads up for two very specific groups. We're looking at a couple of major rule changes that are coming into full force in 2026, and they are going to have a big impact on anyone invested in crypto and on business owners who might be thinking of selling up. First up, crypto. From January 2026, the game completely changes. There's a new international agreement called the Crypto Asset Reporting Framework, or CARF. And what it means is that crypto exchanges, for the first time ever, will be forced to automatically collect your transaction data and send it straight to HMRC. Let me be clear, the days of crypto being a tax gray area are over. HMRC will know what you're doing, which makes reporting your gains accurately absolutely non-negotiable. And second, a really important warning for business owners. There's a fantastic tax relief called Business Asset Disposal Relief, which lets you pay a much lower tax rate when you sell your company. But look what's happening to it. The special rate is being hiked up year on year. A £1 million gain that would have cost you $100,000 in tax a couple of years ago, well, from April 2026, that same gain will cost you £180,000. That is an £80,000 difference. It means that timing your business sale has never been more financially critical. Right, we have covered a huge amount of ground. So before we finish, let's pull all that information together into a simple final checklist. Think of this as your action plan to make sure you stay completely on top of capital gains tax in 2026.
Here are the absolute must-dos. First, keep brilliant records of what you paid for assets and when. Second, if you're selling property, get that CGT on UK property account set up early. Don't wait for the sale to complete. Third, always, always, always use that special X payment reference. Fourth, if you already do a self-assessment tax return, this 60-day report is an extra job. It doesn't replace your annual return. You have to do both. Fifth, know your deadlines, the frantic 60 days for property and the more relaxed timing for everything else. And lastly, the most important point of all, if you are even slightly unsure about any of this, please get professional advice before you do anything.
Okay,
Just before we wrap up, I need to make this clear. The information we've shared today is for general guidance. It's based on the tax laws as they stand in February 2026. And as we all know, these things can change. So please don't rely on this alone to make important financial decisions.
For that kind of specific advice, tailored exactly to your circumstances, we really do recommend getting in touch with the experts who put this whole guide together. You can reach my tax accountant on the phone at 0208-570-8531, or you can drop them an email at info@mytaxaccountant.co.uk. They'll be able to help you navigate your exact situation properly.
So I'll leave you with one final question to think about. Have you properly planned for how these pretty significant tax changes might affect your own financial plans for the future? Thank you so much for your time today, and for more expert insights just like this, make sure you subscribe to My Tax Accountant.